So this session is basically devoted to secondary liquidity. Should it be on the founders' minds early on? What can the company do to enable sort of secondary liquidity? What are the pros and cons, and sort of other considerations, let's say, around primary and secondary transactions? And the secondary element is what we're going to focus here today. My name is Michael Szalontay, and I'm actually the managing partner of the Flashpoint secondary fund. So this is a topic that is definitely very close to my heart. And I would ask all of you to very quickly introduce yourselves to our audience. And, let's start with our golden sponsor of our event, Mike from Latham&Watkins.
Thanks, Michael. So Mike Turner, good afternoon from London. I run our emerging companies practice here in Europe. So looking after companies and investors throughout the tech and life sciences world, from what I call cradle to liquidity, from seed all the way through the alpha into some of the big growth financing rounds today. And pleasure to be with you today.
Excellent. Turning it over to you, Jem.
Hi, everyone. My name is Jen Santolo. I'm a founding partner with Earlybird Digital Lease Fund, which invests into early stage opportunities in what we call emerging Europe, which for us is anything east of Germany and west of Russia. And I'm a founder turned angel investor turned venture capital fund manager, and I've been investing into tech companies since 2005.
Excellent. Thank you, Jem. Scott, you're up.
Yeah, hey everyone. So I'm Scott. I work at Seedrs, which you may know as an equity crowdfunding platform, but you may not know that we've had a secondary market offering liquidity to crowd investors for about 4 years now. And recently, which is part of my role at Seedrs, actually, I do a number of things, but within it is secondary fundraisers. We're starting to open this up more broadly so that investors that have not invested via Seedrs actually also have an early liquidity opportunity too, and that is a recent development that's happened in the last 3 years. So yeah, I'm here flying the flag for crowdfunding and secondary liquidity, and yeah, that's me.
Excellent, thank you guys. So I'll switch to our first question, I think the first thing that I'd like to discuss is when should founders start thinking about secondary liquidity? And I guess the main question that I see troubling founders is, the potential signaling effects of their desire to have secondary at some stage, sort of on the primary fundraise that they need to do in order to launch their business and be successful. So Jem, I think, given that you represent here sort of the traditional VC side, it would be very interesting to hear sort of your thoughts and perspectives on whether you get anxious when you see people planning for secondary liquidity sort of early on.
Of course. And I think as in many things in early stage investing, I think this one's a very nuanced topic. On the one hand, you have situations where, Adam Newman's taking, hundreds of millions of dollars off the table without a business model being proven in the case of WeWork, all the way to, a young founder family who's about to double down on their company, and there's a building up liquidation preference stack on a company of theirs that's perhaps profitable already, looking to secure, a bit of a nest egg in mid-career situations. So I think the landscape is very nuanced. How we see it is we see it as a tool for alignment. In the case that I just mentioned, I think it could be a great way for the founder to be aligned with their venture capital investors who are really only interested in big outcomes, right? So it's essentially doubling down the risk in that venture, and it's, I think, very natural for the founder team to look for a bit of downside protection for themselves, in which case that might be some liquidity on their earlier shares. We also find it to be from time to time a useful tool to essentially broaden and diversify the cap table. Essentially, if they're on the primary round, there's not enough room to bring in enough new smart investors to a company's cap table, then essentially allowing some secondary is a great way to do it. So we are generally warm towards it. In every case, we look to see whether this is reasonable, rational, or are there signals here that we should be reading into. The way that secondary desires come up is also, I think, in some cases telling. But we found it to be a useful tool in short.
Understood. Sort of a similar question, I suppose, is, who should really, when people think about secondary, right, who should be enjoying sort of this opportunity? Should it be sort of for the founders and the employees first and foremost? Or, should early angels, other investors sort of should also be allowed to partake in secondary transactions? Scott, sort of, what do you see emerging on your platform? Who are the people who are looking sort of to get secondary, and how are the investors, I suppose, reacting to different groups of people trying to sell shares?
All right, I'll address the first thing first, which is who should kind of gain the liquidity from the secondary exit event. For me, I mean, there's actually a legal answer to this question, which is most of the time investors have preemption rights on secondary share sales anyway. And I think that just encourages good behavior. To me, it's anybody who's taken any kind of risk, be it monetary or time, in the company at an early stage and has got a while to wait till exit, should have the opportunity to at least cash out past their sum earlier to keep the incentives aligned. Actually, on that point, I want to make I've had this discussion so many times with founders on the platform, and I'm pleased that Chev is positive about secondary liquidity, because to me, I'm gonna give you an example which I think demonstrates the issue we've got at the moment with the taboo, which is, let's say you've got an averagely performing company that gets an exit event. So I know exits for 100 million, and at that point, the founder has 20% of the company. The founder is at that point, getting 20 million roughly out of the share sale, basic maths there. What is the difference in incentivization between the founder taking 2% off the table 3 years down the line, which might get them 300 grand, which buys a house, exit? The difference is 18 million or 20 million. And I don't believe any investor that tells me that they think a founder is less incentivized where there's an 18 million pot of gold at the end of the journey than a 20 million pot of gold at the end of the journey. It just doesn't make any sense. And that also belies the fact that most entrepreneurs start a business because of the mission. So to me, secondary liquidity is got to be one of the things that is absolutely changing the market and actually allowing us to get a more diverse range of founders who are willing to and able to take the risks at an early stage and are happier on the entire journey. And consequently, I guess, coming back to the original part of the question, to me, the people putting the time and the effort and taking the real risks at the start of the business should be the ones that have the opportunity first. And they shouldn't feel guilty about taking that opportunity, because ultimately, like I said, the ridiculousness of the end scenario to me is something that is not discussed enough in this space and should be considered by any person interested in the company that wants it to succeed on an ongoing basis.
Thank you, Scott. I think I can echo your sentiment. Definitely the reason why Flashpoint decided to launch sort of a dedicated secondary fund is because obviously as the tech market, the VC market is growing immensely, we see that VC sort of investments are very long-term in nature. And there's definitely a mismatch between sort of what people might need in terms of liquidity. And this is, as you're rightly saying, first and foremost, a problem for founders. I mean, you can't expect people to be working in a company that is doing amazing and, not really enjoying any of the fruits of their success until an eventual exit, which might take 10, 15 years. But I think it's also quite relevant for sort of early angel and seed stage investors, right? Because even funds have limits on the time horizon of the money that they get from their investors. And exits do take very, very long in some cases. And it's quite hard to manage this mismatch between sort of the asset side and the liability side on the cap table. And we believe that, the principal aim of secondary is to assist in managing these issues. Moving on sort of to the legal side of things, Mike, what do you think people should have in mind early on to make sure that they do have sort of flexibility later on to be able to offer secondaries to investors and make it sort of less convoluted than it often is?
Yeah, and look, just to a point you just made, I think there's secondary and there's secondary. And one of the undoubted influences is the fact that we are seeing so much growth capital in the market that exits are being pushed down the line. So for early stage investors, as Jen will no doubt acknowledge, you can look at a D round and be looking at a 10x on your valuation, and a nice point to see some liquidity for your LPs, even if it's only 50% of your stake or whatever it happens to be. So the demands for secondary are being caused by, first of all, the primary round being oversubscribed. So again, to Jen's point, being able to bring in other investors onto the cap table. Secondly, founders wanting some liquidity for the reasons we just touched on, just to pay the school fees and pay the mortgage. And thirdly, I think there's this point about, as the company is pushing its exit down the line, how do you keep your employees happy? And we're now seeing quite a lot more dedicated programs to grant an employee 25% of his or her share options once exercised by way of liquidity. And it's those types of programs that are being implemented. From a legal perspective, I would say, there's a couple of influences here. You've got to be a little bit careful because, there's some technicalities. If you're coming in at the D round and you're buying some ordinary shares in a secondary, are you paying 80% of the D round price for those shares and holding them as ordinary shares? You're getting them redesignated as the D preference shares. There's some technicalities around that, and you don't get to that except by negotiation with the investors in that round. There's nothing you can particularly do to prepare for that. I think from the founder's perspective, if they're looking for liquidity, my strong advice to founders always is be transparent, be open, talk about it in the round early, and say, I would ideally like to see a small amount of liquidity from this round. I think Jen nailed it by saying it's about alignment and making sure that the investors can feel comfortable that the founders are still aligned with their mission, with the investors' mission as they come in. But it is increasingly the case that investors are very, very happy to see a little bit of liquidity for the founders from let's say a C round on, because it's only right and proper that the founder can enjoy something of a life whilst dedicating it almost exclusively to this business, right? So I think that's important. And the last point I'd make is, yes, it's good to bring new investors onto the cap table and to diversify. And a lot of very, very important venture and growth capital funds have dedicated secondary funds now. So you can bring in some quality investors through secondary. But it's equally important to use the secondary as an exercise in cleaning up the cap table, because it's quite possible you're going to have 40 or 50 angel investors and nuisance investors on the cap table who are going to be just good to clean up, good to remove from the cap table. They'll be happy because they're getting a great return on their investment. It makes management of the company's affairs so much easier going forwards, as Scott will no doubt say.
Indeed. I guess one of the legal limitations that is out there in almost any company that we see certainly are sort of the rights of first refusals, which are baked into sort of the corporate governance. So I guess the interesting perspective, and Jem, this is probably a question for you, as you are sort of investing on the primary side, do you view these rights as an asset for yourself? Are you trying to grab these rights so that you can potentially put your hands on any secondary supply that would be coming from a company? And how do you or are you ready to sort of to let them go? And a second question, which Mike has just brought up, I mean, obviously secondaries usually are from sort of lower classes in terms of the pref stack, right? So whenever the secondary buyers try to upgrade their shares, what is your sort of what are your thoughts on that? And by the way, I'll just very quickly introduce Cankut from Marti, who had slight trouble sort of joining our session. Cankut, great to see you, and we will introduce
I really
you.
apologize, guys. I'm very, very sorry. My laptop did not work, and therefore I needed to find a partner's laptop. I really apologize.
That's great. It's good to have you, and we will ask you some questions shortly. So, Jem, what's your view?
Great to be on board.
Hi, Cankut. No, thank you, Michael. Generally, the way we look at it is we prefer the founder to be at the steering wheel in terms of determining the rights stack and the liquidation preference stack that's that's tied to each of these secondary shares. Of course, as a institutional investor, we do try to focus on proper hygiene when we are entering new investments, and do try to seek the ability to at least have a say in the allocation of secondaries down the line. But I can't think of a single case where the founder preferred the secondary to go to somebody else that they think would be useful to the ultimate outcome of the company, and we would then exercise our rights to block that or to get greedy to get those shares. I mean, at the stages where we invest, and I would probably classify that as anywhere earlier than Series C, I think it's only about the probability of success for this company, because we generally see at early stages the odds are stacked up against the companies. I mean, the founders do need to pull off miracles every day to be able to make the vision work. So, and to us, the capitalization of the company is an important tool, but also the allocation of the shares is also a tool for them to make sure to provide the right incentives for the right people. So we are very I'd say collaborative on pricing of secondaries, on allocation of secondaries, and it's very rarely about the rights for us.
Okay, so does this mean that you're okay if the secondary purchaser is, let's say, looking to upgrade the shares that he's buying from the founder to the latest round?
Well, no. In general, we are generally okay with it if it's a new primary investor just looking to increase their ownership. But if it's a pure secondary transaction providing liquidity or providing an incentive for a new investor coming in, then we feel, because it's got a special purpose, it's really not a financial security per se. It's not really a trading commodity. It's more in line with probably types of compensation. Again, I'm sure there are cases that we could discuss about here that would be exceptions, but in general, we do feel that in those cases the shares would not get upgraded and just either stay as common or in their original right ownership.
Understood. Cankut, you've obviously been sort of on the VC side before, right? And now you're sort of a founder of a great company that is performing well. So I guess my first question to you is, thinking about potential sort of future secondary as a founder, right? How do you feel about sort of pricing and discounts between the latest primary raise and the secondary, especially since, as Jem just mentioned, the ability of the investor to upgrade the shares that he would be buying from the founders, is limited, right? So they will be further down the pref stack. So how do founders sort of feel about this inherent discount? Does it bother them, or are they ready to accept it and understand why it's necessary?
I think that in my role as an investor, perhaps I looked at secondary share sales by founders differently than I do as a founder, right? Because when you are a founder, I think that the case for having at least some liquidity realized is, to a certain extent, I think it's a positive option for founders. I think that with regards to the discount specifically, I think it's largely a function of the demand for the shares of the company. I think it's less so a question of whether we are positive towards it or negative towards it, but usually yes, if it's a sort of undersubscribed or sort of barely fully subscribed transaction, in that case, then yes, there being a discount would make sense because the shares purchased often as well. If it's not an investor selling, if it's a founder or it's a employee, an early employee, for example, an ESOP holder selling, in that case, the shares also don't enjoy, for example, the same liquidation preference and the same rights as other preferred shareholders. And therefore, in that case, I do think a discount is justified. However, depending on the performance of the company, if the performance of the company is such that there's tremendous demand for the secondary, because I'm sure you discussed these topics in the first 15 minutes that I unfortunately missed. If there's tremendous demand for the shares because the round is oversubscribed, in that case, there being no discount, for example, to the secondary evaluation as a function of sort of supply and demand is also possible, and I believe reasonable as well.
Understood. A related question, I suppose, and we've touched upon this topic lightly, I mean, as a founder, secondary potentially is also a tool to show to employees that, the options that they're getting are worth real money, and also are a tool to give them opportunity, to use these options as a source to, buy houses, better their lives, fund the education of their children, whatever they might need. So what's your view on that as a founder? How important it is for you? And do you think that, having secondary will support sort of the value of the options in the eyes of the employees?
Certainly, I think it is certainly a attractive tool beyond sort of giving options to employees, the ability for them to, before the ultimate exit event of the company is realized, giving them an option to sell part of those shares early is an advantage. As a founder, however, the way we have it structured, for example, is such that while they do have that option, the company does have a right of first refusal in the event that they do choose to sell those shares. So can they perform a secondary? Yes. I think that makes it an attractive tool for them. However, in performing that secondary, the company ROFR effectively ensures that sort of if the terms are attractive to the company and the company is willing to essentially offer the same terms as a third-party buyer of those shares, then the company can also retain those shares internally.
Understood. I know that many companies are now taking your last thoughts sort of further, right? And are basically instituting share buyback programs, or sort of, in some cases, not funded by the company, in some cases funded by secondary buyers, in some cases funded by the company, but they sort of are looking to have plans and programs around that. Scott, I guess sort of, you would know more about this, because I think your platform is one of the things that it's trying to achieve is to enable such programs.
Yeah, I guess to strip that down, the problem that we're really trying to solve at Seedrs is giving that demand for the share purchases. So if you're in an event where you've done a primary round and maybe wanted a little bit of a secondary, or as Cankut was just saying, you want to give some liquidity to your employees, we fulfill the demand side for that. We're finding investors that are going to buy it. That's really what we do at its core. So I think, this is something that we're seeing, but very interestingly, what we've seen over the last 6 months is this tends to be something that founders are either a bit worried about because they don't know what the signal is, which was the point I was making earlier, to other potential shareholders, or it's something the founder wants to do during a fundraising journey and not at another point. I guess to that last point, it's a little more understandable than the first, which I just think is a taboo. If you're a founder and you're fundraising, you really fundraise because you want money in your business to grow right now. I mean, that's why you're doing it. Secondary liquidity is not as urgent thing as primary liquidity, and it never will be really. And it feels selfish for founders to do it as well. But the thing I would argue is, especially if you're trying to get early stage talent to the business, having some liquidity for your early employees, etc., is vitally important to the company. And I think it needs to be put up the agenda with where founders are thinking, to be honest, because yeah, look, I work at Seedrs. I have Seedrs shares and options. I've owned them for 4.5 years. Yeah, I'd love to cash out some of them. Doesn't mean I believe any less in Seedrs, but it might stop me going to a competitor, although I have non-competes for that anyway. Look, it's a personal point, but it's something that I hope founders of scaling businesses are going to see more often, and put this above the kind of up in the prioritization list, whereas at the moment it seems to only be an afterthought that people have on primaries. And look, we're here to solve the demand side. The idea is we hope to be running full secondary campaigns that have nothing to do with primaries in the future. But I guess the reality at the moment is these campaigns that we're running and secondary transactions we're doing are as part of primaries more often than not.
Understood. I think we have time for just one last question. So,
Michael, before you go ahead, I do have to apologize and excuse
Absolutely.
myself. I do have a hard stop, but thank you very much. A very nice.
Thank you for being with us.
Bye-bye.
We really appreciate
Bye-bye.
it. Cheers, man. Cheers. So, Mike, the last question is for you, I guess. I mean, how often do you see sort of companies baking into their documents, sort of on the corporate governance side, the opportunity to have sort of these programs to incentivize employees and sort of giving them the opportunity essentially to annually or, biannually to sell some of their options through some structured process?
So look, it's a great question. And the answer is currently very little in Europe, but as with everything we're doing in Europe in this space, we're learning from North America, and in the North American growth companies, these employee liquidity programs are pretty extensive, and we're just seeing them beginning to be introduced in Europe. Now, one of the challenges, it was interesting listening to both Cankut and Scott on this, is that actually technically it's quite difficult to do because your employee option plan needs to allow for it. And often the rules of these plans can be very tight and are going to need some amendment to facilitate the secondary element, which can be a challenge if the plan is a pre-approved tax-efficient plan. And secondly, certain companies, to Cankut's point, in England, we can't buy back shares. The company can't buy shares back. It's almost impossible for a growth tech company to have the accounting wherewithal to be able to buy shares back. So it has to be a third-party purchaser of those shares, which then leads you into all sorts of other regulatory restrictions. So it's technically quite complicated. And my strong advice is that companies should think about it early. I think about it at the time they're putting their option plans together so that they've got the ability to facilitate this down the track. And I think it's particularly useful when the market is beginning to talk about the noise surrounding, the potential IPO of the company, the potential growth of the company, and massive funding round. The employee is sitting there saying, well, that's all very well, but I thought I was joining this company to get some liquidity in 5 years, and it's now been 8 years. And so getting the 25% or whatever it is, liquidity can be a very, very helpful tool, but it needs a lot of thought, a lot of thought
and a lot of planning. Yeah. Unfortunately, our time is up. I hope that, our listeners have understood that planning is very important in secondaries. And, hopefully we've given them some pointers and ideas on what they could do to enable secondaries in the future. And it seems that the VC funds now accept secondaries. The primary players accept secondaries as something that is common and normal phenomenon in the market as it's growing. I'd like to thank you all for helping me in sort of discussing these topics. It was great to see you, and wish you a great day.
See you guys. Take care.
Thanks very much, Michael. Cheers.
Cheers. Bye.